And let's get straight into the day's market action with Katzenellenbogen from Sanlam Private Wealth. Greg, thank you so much for joining us this evening. Let's kick off the conversation looking at monetary policy decisions, starting with the Fed standing pat on rates as expected. Interestingly, though, policymakers were very divided. In fact, the most divided they've been in over 3 decades. How are you reading into that? Are we moving towards a more hawkish tilt?
Well, it certainly looks that way because there were quite a few people on the Fed who actually voted against what they called an easing bias in the language. So that means that they don't feel that there's any necessary now to signal that there'll be lower interest rates ahead, because obviously everyone is concerned about the effects the war is having on inflation, and they're very scared of a stagflationary, where there's growth falls but inflation rises. So that was it was the last meeting for Jerome Powell. So it was interesting that it's the most number of members that have dissented in quite a while.
Yeah, you mentioned there that it was, of course, Jerome Powell's last meeting as Fed chair, but of course he will stay on as governor, and we're likely going to see Kevin Walsh take up that top position. Moving over to what's playing out across the Atlantic, a similar sort of picture coming out of Europe, with the ECB and the Bank of England also keeping rates unchanged, but that hawkish tilt revealing itself a little more when it comes to the ECB and BOE, right?
Yeah, very much so. So Europe is facing a real classic stagflationary shock. Inflation expectations amongst consumers have jumped to 4%. Yet at the same time, banks are signaling the tightest credit conditions since around 2004. So the market has moved from expecting further cuts to now thinking that there could be as many as 3 interest rate hikes by the end of this year, if energy prices do not stabilize. And what's happening on the energy market at the moment is that oil is extremely elevated. So that if it continues like that, then you're likely to see interest rate hikes in Europe.
And it seems like that $100 mark has become the benchmark at this point. And I mean, we're coming from lows of around $60, $65 a barrel around February. So yeah, major shock on that front. Let's shift gears to earnings season. Major tech companies out with numbers. Looking at revenue and profits, the hyperscalers doing pretty well, but share price action has been quite interesting. Alphabet soaring while the other counters dip, Meta in particular under pressure. What are markets reading into those numbers?
So Meta, I can understand, down 9% which is, the market is focusing on really one line in Meta's financial statements, and that is their capex spend, between $125 to $145 billion this year. So the market is spooked by that because they're not quite sure, because essentially about 50% of that is geared to improving Meta's advertising business. And in these results, you've seen how their advertising business has improved. So that is working, but there's about 30% of that 120 odd billion that is set aside for not exactly the metaverse, but these AI glasses. Recently some Ray-Ban sunglasses. So they're looking at that, and the market is not 100% sure that is going to work. So they don't. You saw what happened a few years ago when they spent a huge amount of money on the metaverse. The market didn't like it. It was just eating cash, and the share price collapsed from $350 odd to 88 before recovering. So the market with Meta particularly is just spooked about whether they will be able to monetize this huge spending. It's a lot of money, but I still think that, there are some certainly positives for Meta. Their advertising business is a juggernaut. They're doing
Okay.
exceptionally well. And everyone else has got an AI agent, so theirs is called Llama, but they're giving it away for free,
Aha.
hoping that it will be a similar thing to when what Google did with
Yes.
Android and that. So I still think that at these levels, Meta getting knocked nearly 10% actually offers an opportunity to buy them at these levels. But you are putting a lot of faith in Mark Zuckerberg's vision.
All right. So buying the dip is the name of the game. Let's get into your stock pick then. Where are you seeing value at the moment?
Well, my stock pick is Google, Alphabet. These were the most outstanding results I've seen in a very, very long time. Their revenue was up 22% to $109 billion, and that's the 11th consecutive quarter of double-digit growth. It's just a monster company. Their operating income also rose 30% to just under $40 billion, but their margin expanded by 2 percentage points to around 36%. But Google Cloud is where it's all happening, and that revenue came in at 20 billion as against expectations of 18 billion. But that was an increase of 63% on the last quarter. So it's massive. But it all hinges on one line in their statements. They announced that their backlog is a massive $460 billion. I'll say that again so it can sink in. $460 billion of backlog. That is money that is committed to the company for them to provide all sorts of computing power and things over the next 10 years. And that's like 10 times of Amazon's revenue just sitting in that backlog. So it's really massive. And Google looks an outstanding investment at these levels.
All
Price
right.
currently, it's trading up $24, is up 7%. But I think that's just the start. I expect that this will be
Yeah.
one of the top performers going forward.